Welcome to How to Profit from Behavioral Finance Investing. The central question we address in this book is the following. How do we make financial decisions in the face of uncertainty, complexity, and risk? It turns out that for most people, the answer is not very well. As a result, our financial life is full of losses and missed opportunities, including the opportunities to benefit from other people's mistakes. We like to think of ourselves as rational human beings who bring logic and rational analysis to bear when making decisions, including financial decisions. Under this scenario, we collect all the relevant information on an investment, analyze this information, and then decide which securities to buy and sell, when, at what price, and how much. However, a growing body of knowledge, collectively known as behavioral finance, disagreed with this assessment. It turns out that our decisions are made based on a complex and fluid combination of rational analysis, emotions, and biases in our cognitive facilities. So our decisions are driven, to a lesser or greater extent, by emotions such as fear, elation, optimism, and greed. This course seeks to provide readers with the knowledge and understanding of the ways in which irrational factors impinge on our ability to make financial decisions. The course is a guide to investors, asset managers, and traders on how we could get out of our own way and avoid costly mistakes of our own making. It is also about spotting mistakes made by others in the market so we can profit from those mistakes. Finally, the course lays out a series of tools, strategies, and techniques that can help mitigate the negative effects of emotions and cognitive biases and make us better traders and investors. So what are the contents of this course, and what can you expect to take away once the course is completed? First, we'll examine behavioral finance and show how it differs from classical economic theory, including the efficient market hypothesis. Secondly, we'll look at the theory of the mind, how the mind works, including both its rational and irrational components, and then how we make decisions. Thirdly, we look at how emotions and biases affect our investment decisions, how they cloud our vision, and how they operate in relation to rational decisions. Fourthly, we look at a set of tools and techniques that are designed to mitigate our irrational investment biases. We focus on the narrative audit, which is a technique that we developed to mitigate the effects of the narrative fallacy. The narrative fallacy is a bias that we have whereby we take in information through stories and narrative rather than through facts. And then finally, once we've learned how we make decisions and how our investment biases affect our decision making, we can turn that on other people and look at how we can profit from other people's mistakes. This exaggerated picture is meant to convey in graphic form the fact that decisions are a combination of emotions, cognitive dissonance, heuristics, prospect theory, all of which are concepts that we'll discuss in the course of the next hour. The dominant economic theory about how financial markets work is known as the efficient market hypothesis. According to EMH, market prices reflect all the relevant information about any stock or security. New information is immediately incorporated into a security price, which means that stocks and securities always trade at their fair market value. Another way of expressing this concept is known as the random walk theory, according to which stock prices move in random fashion without any direction, and that it's impossible to buy undervalued or sell overvalued stocks. In other words, it's impossible to meet the marketplace. The efficient market hypothesis theory rests on a number of heroic assumptions. First of all, it assumes that economic man, or the typical investor in the market, is a fully rational investor whose only goal is to maximize his or her wealth. This means that at any given moment, the market can only move if there's new information that the rational economic man is able to calculate into a new market price. Any deviation from the efficient market, any irrationality, is quickly arbitraged away by rational economic man and the information at his or her disposal. Now, EMH does agree that there are irrational investors in the market, but it refers to them as noise investors and assumes that they cancel each other out so that they have no effect on the marketplace or on the efficient market. There are a number of important economic phenomena that efficient market hypothesis is not able to explain. For example, clearly market prices are different from fair value. In fact, sometimes the difference between them is so high, so large, that we refer to bubbles and to crashes. Secondly, it turns out that the risk premium on equities is about 5 or 6% higher than one would expect based on their risk compared to bonds. This is something that EMH is not able to explain. Thirdly, the fact that today's price is to some extent based on previous prices, something known as price momentum and autocorrelation, is a phenomenon that EMH is not able to explain. And then finally, the fact that investment portfolios tend to be overweight securities from one's home countries and at times securities from a company that one works for is something that can't be explained by EMH. The fact that modern economic theory was not able to explain these important market phenomenon has led to the growth of a new branch of economics known as behavioral finance. Now, behavioral finance does not deny all the findings of the efficient market hypothesis. Rather, it changes some of these assumptions and comes up with some different conclusions. Most economists now agree that there is at least some benefit and some truth to behavioral finance. So what does behavioral finance state? Most importantly, it says that emotional and cognitive biases influence investment decisions. This clearly differs from economic man, who is totally rational. It also says that decisions are based on both irrational and rational factors. Decisions are very complex and at any given moment are made by a combination of different factors. It then says that market prices are the outcome of both rational and irrational investors. In other words, irrational investors are not just noise, but they help determine the price of a security and the direction of the market. Fourthly, behavioral finance says that market participants have a variety of goals, not just to maximize their wealth. They have a variety of goals and of objectives, which all means that the markets have inefficiencies that can be exploited for profit. Another theory or concept proposed by Herbert Simon, a Nobel Prize laureate in economics, is called satisficing. According to satisficing, people don't try to maximize their goals, and this is true for a number of reasons. First of all, it would be prohibitively expensive and time-consuming to collect all the relevant information about most investments. Secondly, it's impossible to calculate all the future outcomes both economic conditions and security fundamentals that would be needed to maximize a goal. Thirdly, there's uncertainty of future events. And then finally, there are multiple and conflicting goals that most investors have. According to Herbert Simon, we have to settle for satisficing rather than maximizing. That is, to reach goals to the extent that we're satisfied with the goal, and then use bounded rationality, which means rationality bounded by the inability to collect all the information and by conflicting goals. So to summarize some of the information we've gathered so far, our decision making is flawed in a number of important ways. First of all, decision making includes emotions, mood, sentiment. An example here is risk aversion, the fact that we hold on to losers and sell winners, in contrast to making profits in the marketplace. Decisions are also made on the basis of cognitive biases or heuristic. These are tools that we follow without rational analysis and can sometimes damage the way that we make investments. Examples here are overconfidence, where we think we're better than we are, and framing, which means that our response to information depends on how that information is framed or presented to us. We'll spend a good deal of time on both emotions and cognitive biases and their role in decision making throughout this course. It should not be surprising that our decision making is not ideal for making investment decisions. After all, human beings evolved for reasons other than investing and financial choices. We as Homo sapiens evolved to cope with the dangers and the opportunities on the plains of East Africa. Our emotions and our way of thinking evolved to survive and to thrive in the face of uncertainty and risk in that world. Humans did not evolve to make financial decisions. The next section of the course looks at how our mind works in making investment decisions. It looks at how the different parts of the brains are able to bring together reason, emotions, cognition, and social factors and reach decisions, flawed or not. According to Daniel Kahneman, who's considered by many to be the founding father of behavioral finance, the brain is divided into two parts for purposes of making investment decision. The first part, called System 1, resides in the limbic system and is the fast, automatic, impulsive, and emotional part of our mind. This is where first instincts, first reactions occur when we experience something new or new information. It's also unconscious, and it's associative, which means that it looks at ideas, it looks at events, and then goes back in our past to see if it can find them or something similar to them. The second part of the brain is called thinking, and it's in the neocortex. System 2 is slower, it's conscious, it's reflective. It goes into action after the first reactions are felt by System 1. It's the analytical and rational part of our brain. However, it's also the lazy part of our brain. You'll notice that 95% of the activity comes from System 1. Only 5% comes from System 2, because it takes energy and it takes concentration to bring System 2 into action. Normally, System 2 is happy to let System 1, which is fast and automatic and does not take any additional energy, to come into action to make decisions. Let's look at System 1 more closely. System 1 is where we have our instincts and where we have our emotions. It's fast, it's automatic, and it's where the emotional component of our brain is located. This is where we feel fear, happiness, greed, anger, and so on. It's also associative. when we see something new or collect new information, System 1 goes into our past and tries to find something similar, a similar association, and bring that forward to compare to the new information. However, very often the association is not exactly the same. It has differences, and those differences can lead to irrational decisions. Then finally, System 1 is where instincts such as fight or flight, risk aversion take place. Instincts such as fight or flight were more appropriate to our early evolution when we faced dangers like saber-toothed tiger. However, we still have them as part of our makeup, and these types of instincts cause problems in investment decisions. We speak a lot about our emotions in this course, so let's take a closer look at the emotions. Example of emotions would be happiness, sadness, fear, anger, greed, trust. Emotions, because they come from System 1, are different from the cognitive state, which is in System 2. The cognitive state is one that's rational and logical. Emotions are not. Emotions rise spontaneously without conscious effort. They rise in response to external events. And this is the key point. Emotions are part of every decision-making process. Whether we want to or not, emotions will arise no matter what happens in the environment, and they have to be factored into every decision. They're also accompanied by physiological symptoms, and these can also sometimes affect investment decisions. System 2, the seat for cognition and heuristics, is different from System 1. It's slower, it's conscious, it's a logical part of the brain. It evolved later in human development than System 1. To some people, this is what differentiates us from other animals. It takes time, effort, and energy to access System 2 and to get it working. System 2 is the system that collects and analyzes information and that makes decisions. Now, it would be nice if System 2 were purely rational, like economic man and modern economic theory. However, it turns out that cognition of System 2 also includes shortcuts or heuristics that often lead to irrational decision making. Well, what are heuristics? Heuristics are shortcuts or rule of thumb that our brain uses when it makes decisions. When decisions are made in the face of complexity and uncertainty, we need to have these types of shortcuts and heuristics. They're learned or hard-coded by evolution, so they're inescapable and they come up in decision making. An example would be hitting the brake when we see a red light. We don't process information, collect information, analyze it, and then decide to hit the brake. When we see the red light, heuristics or the rule of thumb kicks in and we automatically hit the brake. Because of its automatic nature and the fact that it intrudes on the cognitive process, it could lead to irrational decisions, and indeed it does. We talked extensively about individual emotions. Now it's time to look at markets, the way individuals come together and set prices and set market directions. We do talk about emotional markets. For example, we say that markets are depressed, exuberant, bipolar, euphoric. We spend quite a bit of time and money collecting information on market sentiment. However, the market is comprised of a combination of rational and irrational participants. The irrational investors are not noise, rather they're part of the mix, and the combination of irrational and rational investors is what makes for a marketplace. Another important phenomenon that affects our investment decisions is known as cognitive dissonance. Cognitive dissonance occurs when we hold contradictory beliefs or engage in contradictory actions. An example is if we're uncertain about a stock and at the same time believe that it will go up and that it will go down. It turns out that cognitive dissonance is very uncomfortable for people. It causes mental anguish and physiological problems, and people will do almost anything to avoid cognitive dissonance. Well, there are a number of steps that people take. One is to change one or more of the beliefs or behavior. So in the previous example, if one chooses one view, i.e. that the stock is going up, then that would relieve the cognitive dissonance. Another approach is to acquire new information and use the new information to evaluate the contradictory beliefs and then reach a decision. And a third way, which is very common and is very harmful to decision making, is to discount conflicting information. So if one chooses one scenario, for example, that stocks will go up, then any information that stocks will go down would set off cognitive dissonance, so it's discounted or ignored. Another area which has cast substantial light on financial decision making is neuroeconomics. Neuroeconomics deals with the chemicals produced by our body and by our brain in the course of making investment decisions. For example, testosterone is one such chemical. It provides a surge of energy and of optimism. However, in too large a dose, it can also cause over-optimism and lead us to take risky behavior without realizing how much risk we're assuming. Dopamine is another chemical that's produced in the course of decision making. Dopamine provides pleasure and excitement. Again, in moderate doses, it's good for us. However, too much dopamine leads to over-optimism and over-trading. Dopamine is also the chemical that gives pleasure from gambling and from trading. Serotonin is associated with anxiety, fear, fight or flight. We need a certain amount in order to make decisions. However, an excess of serotonin leads to anxiety and fear. Finally, cortisol is a chemical that's produced when we undergo long-term stress. It causes anxiety, excessive risk-taking, irritability. It's something that afflicts traders and investors who are under stress for long periods of time. And then finally, a note on mood. We talk a lot about emotions. Emotions are attached to specific issues. So for example, we like a stock or we dislike the market at a certain point. A mood is different. Mood is a general feeling that touches on everything. A mood can affect information and the way we take in information, and it could certainly affect decisions, including investment decisions. For example, when we're in a good mood, we're more likely to take in optimistic information about a stock, say, or about the market. And in a good mood, we're also more likely to engage in risk-taking behavior and in over-trading. The next part of the course is a rather lengthy treatment of emotional and cognitive biases and the way they affect our investment decisions. For each bias and for each emotion, we follow the same procedure. We first define and give examples, and then secondly, we look at the implications for investing and trading. The first emotional bias that we look at is overconfidence. Overconfidence is a tendency to place excessive faith in our own beliefs and abilities. Overconfidence results in exaggeration of our own skill and the denial of the role of chance or external events. This in turn causes over-optimism about our abilities to predict the future. Another outcome of overconfidence is that we attribute good outcome to our own abilities and bad outcomes to external events. We also have a tendency to look at the past and create stories that make the past seem inevitable. Another outcome is the illusion of control that comes from overconfidence. This is a bias that exaggerates our ability to control situation and events, including the random results of investments or trades and the future. Unfortunately, studies show that investors with higher illusion of control tend to have worse performances. Garrison Keillor, an observer, once wrote that Lake Wobegon, a fictitious town where all the women are strong, all the men are good looking, and all the children are above average. Other examples include a survey of 400 professionals in foreign exchange found that 75% felt that they were better than average among their peer group. 94% of college professors thought they were better teachers than the average, and 80% of drivers thought that they were better than average. So what are the implications for trading and investing of overconfidence? With overconfidence, we tend to replace market reality with our own views because we believe that our views are true. It also leads to overtrading because we believe that we know which way the market is going. We tend to overtrade. Unfortunately, there is evidence that overtrading leads to poorer results. People who trade more tend to do worse than people who trade less. Hindsight bias also prevents us from learning from our past mistakes. Because we feel that anything that goes wrong in the past is not our responsibility, we don't learn the mistakes that we've made, and we're destined to make those mistakes in the future. Then finally, hindsight bias and overconfidence together cause the illusion of control, which means that random events and random market movements we consider to be under our control and leads us to make investment mistakes. Next, we look at prospect theory, which is one of the most important theories in behavioral finance. The basic idea is that we suffer greater pain from a financial loss than pleasure from an equivalent gain. This is shown graphically to the right. A $50 gain gives us a certain amount of joy or satisfaction. However, a $50 loss causes us much greater pain. In fact, one would need a gain of $112.50 to offset the negative feeling of a $50 loss. This causes loss aversion. Because we suffer more in losing than in gaining, we have a tendency to err on the side of averting losses. It's also related to the feelings of regret, another very uncomfortable feeling, and one that prevents us from taking action because of this feeling. Then next, it also indicates that realized gains or losses are felt more strongly than paper gains or losses, and this has important implications for trading. There are a number of implications for trading and investment that flow from prospect theory. First, there's a possibility of missing investment opportunities. Because of loss aversion and regret aversion, we're sometimes hesitant to take positions so we don't feel the loss or the regret. We also have a tendency to take profit on a winning position. This is because if we have a winning position, any additional wins is only going to provide a small amount of satisfaction. And on the other hand, we allow losses to accumulate because any losses cause us so much pain that we don't want to close out the position. The end result is that we close out winners and let losers ride, which is exactly the opposite of successful trading that says close out losers and let winners ride. It also means that we hold on to paper losses because the pain of actualizing the losses, actually taking the loss, is too great. The next emotional bias we discuss is the endowment bias, also known as the disposition bias. By this bias, we suffer a psychic pain when we lose securities in our portfolios. We place a higher value on securities than we own on securities that we don't own. This is true even if the security is a recent acquisition, and it's true for items of equal value. In other words, if we own a security in our portfolio, then we place a higher value on that security than we do on a security we don't own, even if they are of equal value. This means that we hold on to investments even if it's irrational to do so because of the endowment effect. Well, what are the implications for trading and investment of the endowment effect? It means that we keep securities, we hold on to securities that we own, even if they're above their intrinsic worth and it's rational to sell them. It also prevents us from selling inferior investments or purchasing superior investments because we're holding on to the inferior ones in our portfolio. The endowment effect adds a non-economic emotional value to the value of an investment. That makes us susceptible to advertising. Advertising causes the endowment effect to strengthen and to want to keep an investment even more. It also means that we make decisions based on like or dislike. For example, we may like environmentally friendly stock or dislike some other investment for no particular reason other than emotional attachment. Next, we look at anchoring, which is a cognitive bias. Anchoring means that we focus on one piece of information, usually the purchase price or the first number that's given. And it means that subsequent decisions are made with reference to the anchor instead of to the market. For example, if we purchase a stock at $50, the $50 becomes the anchor. If the stock goes to $30, the decision to sell or not is made by reference to that $50. We view this as a loss of $20, and because of prospect theory, we're hesitant to sell that security, even if the market has gone against it and the fundamentals argue that we should sell. Finally, the forecast of future price is also based on an anchor. The implication for trading and investing of anchoring include the following. Firstly, we buy or sell based on an anchor price rather than based on the market price or the fair value price of any security. Secondly, a price is seen in terms of gain or loss compared to an anchor detached from market value or detached from fair value. Now, new price of the security may come from economic conditions or changes in the company's fundamentals, but we don't take that into account. There's a tendency to block out new information or to formulate a new anchor because the initial anchor is still the one that we use as a reference. Confirmation bias is another cognitive bias that can distort our ability to make rational decisions. By confirmation bias, we mean that only information that confirms a belief is considered by us to be legitimate. Information that contradicts what we believe is either minimized or is ignored. Confirmation bias is one way of escaping the pain of cognitive dissonance because we block out any contradictory information that could cause that dissonance. Confirmation bias has become more important with the 24/7 information that we're bombarded with because escaping becomes more and more difficult the more information that we receive. There are several implications of the confirmation bias. Firstly, it means that we selectively intake information that only supports our position. This means that we either ignore or minimize information from publications, from journals, and from experts because of this confirmation bias. It also means that we hold on to poor investments because we reject information that tells us that these are poor investments. And we also forego potentially profitable investments for the same reason. Availability and familiarity are cognitive biases. According to these biases, decisions are made on the availability of familiar information. Availability here refers to availability within ourselves, the ease with which we can call up information about a particular investment and how familiar that information is to us. It means that decisions are based on non-objective factors rather than looking at the market or the objective condition of a security. We look at how available it is to our memory. It means that we make poor trading decisions and poor investment decisions. And it also means that we act on information that may be the latest information that we gain. Unfortunately, that latest information may be advertising, it may be biased expert opinion, but at any rate, it's not an objective analysis of a security. The implications for trading and investing, first off, it means that we purchase or invest in known, familiar stocks or securities. It also means that in calm markets, the available image is one of low volatility. This leaves us unprepared for periods when volatility comes back into the market and becomes more of a shock than it otherwise would be. And then finally, the familiarity and availability bias means that we can more easily be manipulated by advertisers and by relying on brands. Advertisers know this, which is why they have repeated and loud advertising of stock names and mutual funds. And it's why we tend to invest in brand names that we trust, irregardless of how good an investment they are. Mental accounting is another cognitive bias that may interfere with rational decision making. With mental accounting, we tend to separate money into various mental accounts based on some subjective criteria. The criteria could be the source of the money or the intended use of the money in each account. It means that we think of a dollar as being more valuable in one context than in another context. The implications of this is that we use money differently depending on which of the mental accounts it sits in. So for example, money from bonus will be used differently than money from salary. Bonus money may go towards large acquisitions, while salary goes for day-to-day expenses. It also means that we can have one account that earns a minimal rate of interest, while at the same time another account is paying 25% on the credit card bill. It also means that we may treat profits differently from losses. Profits may sit in one account, losses in another account, and because of prospect theory, we would treat that money differently depending on which account it resides. Gambler's fallacy, also known as Monte Carlo fallacy, has important implications for many investors. As an example of gambler's fallacy, suppose you're playing roulette and 3 reds in a row show up. Under gambler's fallacy, you assume that the 3 reds in a row gives information about the outcome of the next roll. However, the next roll could be either black or red, entirely even chance of both. In other words, we see a pattern where no pattern exists. We're terrible at calculating probabilities, and that makes sense from an evolutionary standpoint. When our ancestors saw a saber-toothed tiger, they did not have time to look at the probability that the saber-toothed tiger will attack them. They have to make a decision and then to run. Now, to make it more close to home, the fact that the market has gone up for 3 days in a row is seen as proof that it will rise the next day or that it will revert to the mean. However, according to efficient markets, it means that the next day could be either up or down. There are important implications of the gambler's fallacy for trading and for investing. One of these is the law of small numbers. Under this law, we rely on data samples that are too small, very recent, or very different than the norm, and assume that they represent the universe. So, for example, a short track record for a mutual fund is taken to imply that there will be outperformance in the future. We take funds with the best recent track record and project it out into the future. It also leads us to ignore reversion to mean. The reason is that we take outliers, say the stock market has gone up 3 days in a row, and that's an exception. We assume that that's the norm, and we assume that the next day will lead to an up market. However, it could be that the 4 days in a row is an outlier, and in reality, the next move will be a reversion to the mean. The last cognitive bias we'll discuss is the framing bias. According to this bias, information is always presented to us in a frame or in a context, and that decisions are based on this information, on this frame. So, for example, we'll react positively to an investment that's presented to us in a positive frame, and we'll react negatively to an investment that is presented to us in a negative frame. For example, something presented as having a 95% chance of success is viewed much more optimistically than something which is given a 5% chance of failure, even though the information is the same in both frames. The implications for trading of framing. First, it's important to realize that framing is present in just about every situation and every decision. There's no such thing as a neutral presentation. It means that we're influenced by the manner in which information is presented to us, and that leads us to purchase or to sell securities on the basis of the framing bias rather than the objective reality of the security. The final emotional bias we look at is crowd behavior or herd behavior. Wherever there's a market, there is crowd behavior. We evolved as social beings, and seeking the approval of our social peers is very important to us. That means that crowd behavior is something that's part of our makeup, and normally that's a survival instinct. However, it can also result in market bubbles or panic sell-offs. If enough of a crowd all go in the same direction and there's social pressure of non-investors to invest in the same way, then that's how bubbles and panics can form. Now, there's a distinction between herding and crowding. Crowding is when a number of actors, say institutions or funds, all purchase the same stock for whatever reason. That is a distinction between that and herding. Herding is where a large group of investors all invest because of social pressures. What are the implications of this? The risk is that crowd behavior will generate a self-reinforcing market movement, which can cause bubbles. The more people invest in a market, the more social pressure there is on non-investors to join the crowd. It means, for example, that we invest in a fund with good recent track record or good management, even though there's no evidence that a track record or good management says anything about future performance of that fund. The more people in a crowd, the more pressure there is to join. And this is one of the reasons that successful Ponzi schemes exist. Investments are made because more and more people invest, and as more people invest, more non-investors join the crowd until there's a panic sell-off at the end.
The next part of the course deals with measuring market mood and market sentiment. As we've said before, there's no independent market outside of the aggregation of the participants in the marketplace. However, substantial time and resource has been allocated to trying to measure what the market sentiment is. An excellent way of describing market sentiment is to quote at length a quote by Warren Buffett. According to Warren Buffett, Ben Graham described the mental attitude toward market fluctuations. Imagine market quotations as coming from Mr. Market, who appears daily and names a price at which he will either buy your interest or sell you his shares. Even though the business may be stable, Mr. Market's quotations will be anything but, for the poor fellow has incurable emotional problems. At times he feels euphoric. When in that mood, he names a very high buy-sell price. At other times, he is depressed. On these occasions, he will name a very low price. One common measure of market sentiment is known as risk on, risk off, or RORO. With RORO, investors switch between riskier and less risky assets. When they're optimistic, they will invest in riskier assets. When they're pessimistic, they'll invest in less risky assets. The switch typically follows economic and political events in the global market. For example, announcements from central banks or commodity prices or announcements regarding China's economic growth are all sufficient to switch the market from a risk on to a risk off. Risk on markets are ones that tend to have higher yield but also more volatility, and they include commodities, high yield and emerging market bonds, NASDAQ, high tech, commodity currencies such as Australian and Canadian dollars, and the European euro and the British pound. Risk-off markets favor U.S. government bonds, U.S. dollar, Swiss franc, and gold. Another way of getting at market sentiment is to measure the behavior and the attitudes of the market participants themselves. The attempts to measure market sentiment of the market participants has a number of different measures. Some measure consumers directly, others measure professional sentiments. Examples include the American Association of Individual Investors, which polls individual investors, the Chicago Board of Options Exchange Volatility Index, known as VIX, the CBOE put-to-call ratio. The higher the ratio, i.e. the more puts are purchased on the CBOE, the more pessimistic the market is about stocks. Then the Conference Board Consumer Confidence Index, and finally the New York Stock Exchange new high to new low ratio. Another way to measure market sentiment is to analyze news items, Google searches, and social networks such as Twitter. This method entails massive databases and algorithms that analyze the data in order to measure market sentiment. One example is Google Trends, which measures the number of web searches for keywords that indicate market sentiment. Another is the Thomson Reuters News Analytics. This service does real-time analysis of financial news looking at a variety of media around the world. Similar service is RavenPack News Analytics, which, according to the company, looks at real-time structured sentiment, relevance, and novelty data for entities and events detected in the unstructured text published by reliable sources. Another way of analyzing market sentiment is to look at investor sentiment as a function of the business cycle. Market participants experience longer-term moods depending on where we are in the business cycle. As the graph shows, there are a range of emotions and moods during different phases of the business cycle. You have euphoria at the peak, for example, and depression at the trough. And then in between, you have fear, panic, hope, relief, optimism, and so on. As the mood changes over time, investment decisions will vary as well. Yet another way of gauging market sentiment and looking at the direction of the market or of individual stocks is by looking at the momentum and technical analysis. You'll recall that a central tenet of the efficient market hypothesis is that security prices are random and independent of each other. However, technical analysis, part of behavioral finance, is a methodology for forecasting the direction of prices through the study of past market data, primarily price data and volume data. The methods that are used include momentum, moving average, and charting. They all depend on the existence of serial autocorrelation that's used to measure price direction. Serial correlation means that one price is dependent on another price in a series in the marketplace. This graph is a composite and shows the various types of technical analysis, including the momentum, the moving average, and the charts as well. Financial bubbles are a very important phenomenon in the financial markets. They're characterized by a sharp upward movement in market prices with widespread participation by investors and speculators over a sustained period of time. Bubbles are characterized by the fact that prices are detached from fundamentals and from fair value. They spike up despite any changes in fundamentals or in the fair value. Financial bubbles can occur in any asset class, whether it's stocks, commodities, real estate, or in bonds. They occur every 5 or 10 years as the memory of the previous bubble and crash fades and people become optimistic again. And they also tend to occur during periods of easy money when credit is widely available so that speculators and investors can leverage up their investments, and it fosters wider participation in the market. There are a number of recent examples of bubbles. The two prominent ones are the dot-com bubble, the internet stock bubble of 2001, and the housing price bubbles, which burst in 2008. We're going to go through some charts now that show the bubble and also discuss whether we're in a bubble now in stocks and or in bonds. So this is what the dot-com or the internet bubble looked like. Clearly, the spike in 2000, 2001 was a bubble in retrospect. Bubbles are very hard to see while they're happening, and there's a lot of debate about it, but clearly we can see the enormous spike in the NASDAQ from 1,000 up to 5,000, and then just as dramatic a decline from 5,000 back to 1,000. Now the question is whether we're in another bubble at the present time. Starting in 1988, the markets went up dramatically. They came down again in 2015, but now they're on an upward spike again. And the question is whether this is a bubble or just a temporary phenomenon that will revert back to the mean. This shows the housing bubble that burst in 2008 and led to the dramatic recession of 2009. And again, it's easy to see in retrospect that the price of houses went up dramatically in 2005, 2006, and even in 2004. And then when the bubble burst in 2008, 2009, they collapsed and reverted back to their mean positions. Another market where there's a debate whether we're in a bubble or not is the bond market. Now here we have a dramatic decline in interest rates, which means that we have an upward movement in bonds that went from about 6.5% in 2001. Starting in 2001, the reserve banks around the world started to loosen monetary policy to prevent a recession, and they loosened it even more after the 2008-2009 recession, to the point where now US interest rates are at about 2% for the long bond, but interest rates in Japan and in Europe are closer to 1% and 0%. Whether we're in a bubble remains to be seen here as well. There's also a question of whether individual stocks can go through a bubble. Apple stock is one example. The Apple stocks have shown some of the attributes of a bubble. Stock prices have gone up and down dramatically. They have less to do with change in fundamentals and more to do with investors' feeling toward Apple, whether they're in a greed or a fear mode. There's also a very different outlook of owners of Apple stock and non-owners of Apple stock. This relates back to the disposition effect. Those that own Apple stock see it as much more valuable than those that don't have Apple stocks. Here's a look at the Apple stock prices over the last several years. And clearly between 2010 and 2012, there was a sharp rise with wide volume and wide transactions in Apple stock. There was a retrenchment in 2013, 2014, but then the spike continued in 2015 and into 2016. Here again, the question is whether there's a bubble that has formed in Apple stock, and if so, when it will burst. We all love a good story. From our earliest days, we're used to taking in information and taking in cultural and moral issues with a story or with a narrative. However, in investing, a narrative can sometimes cause fallacies, and in the next section of the course, we go into the fallacy and into the narrative. It turns out that as people, we're wired to think in terms of stories or narratives. Narratives bring order to events that may be random. For example, when we read a story about a Dow Jones, it doesn't just state that the Dow Jones moved up by 5 points. It has a long narrative that explains the various reasons why the Dow Jones went up, with quotes by experts who also spin a narrative. In a narrative, the elements are all linked together and everything is explained by causal relationships. One event causes another event until we feel that we understand what happened. Random events or events that don't fit into the narrative are either excluded or minimized or forgotten. Which brings us to the narrative fallacy. Narratives in themselves are not necessarily a bad thing. A story is an economical way for our brain to process information. We would soon run out of space and energy if we tried to remember every aspect of reality. In this case, this is similar to what we saw before in the heuristics or the shortcuts. It's a way for us to deal with the complexity of the world. It's also a way for us to remember certain facts and certain events which can be recalled quickly because they're part of a narrative. However, it doesn't matter if the narrative resembles the real world. Because we take these shortcuts and because we only include events that are part of the narrative, it means that sometimes we have a distorted view of what happened, especially in the sense that we have causality. In other words, when we have a story, we think that one event causes another event, when in reality they're random. Nassim Taleb, a critic and philosopher, called this the narrative fallacy. He defined it as looking backward and creating a pattern to fit events and causation, even if these don't exist. Narratives and narrative fallacy occur in a wide variety of places in the investment world. We have company narrative, for example, stories of how companies are doing and how we expect them to perform. Stock narrative, similar information about particular stocks. Investment theme narrative, For example, the possibility that consumer stocks will go up during the next phase of the business cycle. We have economic narratives that discuss whether we have a recession or inflation, political narratives that discuss election races, for example, and election results, strategy narratives that talk about how companies plan to grow in the future, and product narratives, also known as advertising. Which brings us to the narrative audit. Because narratives are potentially a hindrance to our making rational decisions, we developed a narrative audit, which is a way to look at narratives and disaggregate them, strip down a narrative story, and separate out the factual elements of the story and the narrative components. It's then possible to look only at the factual elements and see whether they hold up or don't hold up. We'll take a look at the recent rise and fall of mortgage-backed securities and use that as an example of how the narrative audit works. In the years 2005 through 2008, billions of dollars worth of mortgage-backed securities were sold to investors all over the world. Mortgage-backed securities are essentially bonds whose repayment of principal and interest comes from thousands of mortgages that back the particular security. The story or the narrative behind these mortgage-backed securities and the reason they were sold so widely is as follows. First, it was stated that subprime mortgage-backed securities are an excellent investment because of their high yield and their low risk. Subprime is mortgages that are given to mortgage holders whose credit rating is very low. Another element of the narrative is that because they're backed by mortgages and the price of houses has been rising and will continue to rise in the future, the credit worthiness of the mortgage holders was largely irrelevant. In other words, the bonds would be repaid because the price of houses were going up, not because the mortgage holders had the credit or the wherewithal to pay for the mortgages. In addition, mortgage-backed securities had built-in features such as waterfalls that protect investors. And then finally, preferred investors, those who purchased a AAA tranche of a mortgage-backed security, had a AAA rating by the major rating agencies. In other words, this tranche of mortgage-backed securities had the same credit risk as U.S. government bonds. The key elements of this narrative, the parts that have to be examined, are the high yield, the continued rise of housing prices, and investor protection in case of defaults. All the other parts of the narrative are either conjecture or color background. These three elements, high yield, continued rise of housing prices, and investor protection in case of defaults, these are the factual parts of the narrative that need to be examined. First, let's take a look at high yields. This shows the credit spreads of U.S. subprime mortgages above U.S. Treasuries. As you can see, in 2006 going into 2007, the credit spread between subprime mortgages and U.S. Treasuries were practically zero for tranches A and for tranches AAA. It started to spike up, the credit spread started to spike up in 2007 as some of the bonds became more and more risky. And then in 2007, you had a large spike. But the important thing is that those who purchased the bonds in 2006, 2007 were in fact getting very low credit spreads over treasuries, certainly not enough to compensate them for the risks. Another element of the narrative is that housing prices would continue to rise. As you can see here, starting in 1999 into 2000, all the way through 2006 and 7, The price of houses had all the characteristics of a bubble. The price went well beyond the norm in terms of the growth of housing prices, and by 2007 were well above the normal mean that houses had shown before. And then finally, the waterfall structure that was supposed to give credit support in case the bond started to default or the mortgage holder started to default was so complicated that it's unlikely that very many investors actually knew what that credit protection was all about. It should be clear by now that it's impossible to fully eliminate biases. There are too many, and too many of them come automatically to us, like heuristics and emotions. However, there are tools and techniques that can mitigate the negative effect of these biases. The last section of the course will go through and discuss these techniques. First one, which might sound trite, but is extremely important, is to know thyself in our role as investment and as traders. This means, first off, admitting that we have biases. No matter how disciplined we are and how knowledgeable we are, we still have biases because they're built into us as human beings. It's not a sign of weakness. These biases are necessary for us to survive. What we need to do, though, is to explore where these biases influence our trading and our investing. It means that we have to look at both emotions and cognitive biases and figure out and document exactly what parts of our investment and trading are negatively influenced by these biases. Understanding ourselves is critical to profiting from others' behavioral mistakes. By understanding ourselves, we can place ourselves in the shoes of other investors, figure out what their behavioral mistakes are, and then try to profit from those mistakes. Secondly, we look at mindfulness. Mindfulness is meditation that focuses awareness on the present moment while acknowledging and accepting feelings, thoughts, and bodily sensations. Mindfulness accomplishes two goals. First, it facilitates a clear knowledge of the emotional and cognitive biases that impede success. Secondly, mindfulness gives a restfulness, a calming of animal spirits that allows us to have more rational analysis and rational decisions. Mindfulness has now become part of corporations, of boardrooms, and of trading rooms. It used to be an esoteric phenomenon. Now it's acknowledged to provide benefits and is being adopted by companies worldwide. There are many manuals, many courses that teach this method of meditation and how it could be applied to investments and to trading. Our website's Investment Education Forum provides a list of some of these. Another element of mitigating biases is physical fitness. There is a strong link between the body and the mind. For example, tiredness inhibits clear logical thoughts and rational decision making. It means that we need to get enough sleep to make sure that we can think clearly and rationally. Exercise releases chemicals such as dopamine that provide energy and focus, as well as aiding in memory and task completion. Diet is also key for chemical balance in both your mind and your body. Next, one should always play devil's advocate or find someone else who will play devil's advocate to test their assumptions and beliefs. One needs to look for information and opinions that contradict your decisions and your beliefs. This forces you to defend your decisions on a rational rather than emotional level. Ideally, this would be an individual, someone you respect, or a group of individuals. However, if this is not available, then expertise, newspaper articles, and websites will do the trick as well. One has to develop a methodology for gaining new information. This means following new publications that may present the other side of your belief and opinion, looking at internet sites, reaching out to colleagues and friends to share their views. Next is emotions and biases checklist. This is a very important tool for trying to identify and to mitigate emotional biases and cognitive biases. This entails keeping a checklist similar to the way that pilots go through a comprehensive checklist before they fly. Before making investments or trading decisions, we should follow a similar idea and have a checklist ready. We have a copy of a comprehensive checklist on our website, www.emotionalmarkets.com. Here is some of the questions or some of the areas that should be looked at in the checklist. It should list some of the most common biases and behavioral errors. For example, one question in the checklist might be, are you using today's market price for the valuation of investments rather than historic or emotional prices? Another question would be, are we viewing our investments in the proper time frame? Are we confusing short-term, medium-term, and long-term investments or treating each differently? Closely related to this is keeping a journal. We tend to remember history selectively and we forget many things. We're also liable to have overconfidence and over-optimism in our ability to remember history. Keeping a contemporaneous detailed record of all our trading and investment decisions is a way to combat these. One should put in the journal the reasons for making these decisions, these investments, an exit plan for when to reverse the decision, and an understanding that investments turn out to be mistakes or understanding why they turned out to be mistakes. This is a discipline for uncovering the biases in your decisions and a plan for keeping our emotions in check. One should also keep journals of our forecasts. It's easy to play Monday morning quarterback and to imagine that we had the right forecast after the fact. Keeping a journal will show us whether this is indeed true or whether we imagined that we actually had the correct forecast. Another way of mitigating our biases is to establish clear targets and benchmarks at the same time that we put on a trade or an investment. These targets and benchmarks should also include a course of action that we will follow if these targets or benchmarks are achieved. These targets should only be changed if under a formal procedure and only if there's a change in the fundamentals or in your own goals or objectives. These establishment of targets and benchmark are useful in overcoming the disposition bias, which is our unwillingness to sell securities that we have in our portfolio, and also prospect theory, where we tend to let losses ride and take profits too early. We need to learn the basics of probability. This doesn't mean that we need to become statisticians. However, we do need to overcome biases that confuse random events or luck with patterns. Just to review some of these, learning the basic rules of probability includes learning about gambler's dilemma. In the case of independent events, i.e. each toss of the dice, the odds of any specific outcome on the next event remains the same regardless of what preceded it. Similarly, in a large group of funds, by statistics and probability, some will show superior performance purely by random chance. And then finally, the law of small numbers, which means or states that you cannot extrapolate the future on the basis of a small sampling of past patterns. And then finally, avoid herd behavior. This is difficult because we as people are social animals. We want approval of our peers and we want to belong. However, it's important to check our emotions and our decisions for signs that we've abandoned our own independence, our own rational decision-making process, and given into our social emotions. Herd behavior is common when a topic becomes the subject of widespread discussion in the media or among people, and this is where it's especially important to maintain independence. It's important to keep a critical detachment and independence so that you can evaluate securities and evaluate investments on the basis of their intrinsic value and of fundamentals. In conclusion, people are a bundle of contradictions when it comes to making investment or trading decisions. On the one hand, we're capable of the most rational and logical analysis of our decisions. On the other, we're blind to a wide range of emotions and biases that seriously undermine our ability to make logical decisions. It is only by understanding this dichotomy and taking steps to mitigate its pernicious effects that we become better at financial decisions. Fortunately for us, the journey is rewarding, not only in terms of our financial selves, but for other aspects of our lives as well. Updates, case studies, resource lists, and guest articles are continually posted in the course's website. Handouts and PDF forms are also available on the website at www.investmenteducationforum.com. Thank you for attending this course, and I hope that it will help you in your trading and your investment life.